If you're keeping your emergency fund in a standard checking account, you are literally paying the bank to hold your money. Let that sink in. You are paying them, not just in fees, but in lost opportunity. Every day your cash sits there earning 0.01% interest. Inflation is quietly eating away at its purchasing power. It's like watching a block of ice melt in a warm room, but the warm room is the global economy. Hi everyone, welcome back to Fiscal Beacon. I'm your host, and today we are pulling back the curtain on one of the most fundamental tools in personal finance, the High Yield Savings Account, or HYSA. If you've been intimidated by the stock market or just want a safe place to park your cash, this video is for you. We're going to answer the big question: what actually happens to your money once it hits that account? We'll look at the mechanics, the math, and the myths. By the end of this video, you'll know exactly why you should care, how to choose the right account, and when it's time to move on. Let's dive in. So let's start with the basics. What is a high-yield savings account? It's a deposit account offered by banks and credit unions that pays a higher interest rate than a traditional savings account. That's it. It's not a stock. It's not a bond. It's not a crypto wallet. It is literally cash in a digital vault. But here is the part most people skip. Why does this vault pay you more? Why would a bank give you 4% or 5% APY when a traditional bank gives you 0.01%? The answer lies in what the bank does with your money. When you deposit $10,000 into a HYSA, that money doesn't just sit in a server. The bank lends it out. They lend it to other people. Maybe it's a mortgage for a family buying a home. Maybe it's a business loan for a small company expanding its operations. Or maybe it's a credit card balance for someone carrying debt. The bank charges that borrower, let's say, 7% interest on their loan. Then they keep a cut for their overhead and profit, and they pass a portion of that remaining interest back to you. You are essentially the bank's investor. You are funding the economy, and in return, they pay you rent for using your capital. This is why HYSA rates are tied to the Federal Reserve's benchmark interest rate. When the Fed raises rates to fight inflation, the cost of borrowing goes up. Banks can charge more for loans, so they can afford to pay you more. When the Fed cuts rates, your HYSA rate will likely drop. This is a crucial concept. Your savings rate is not fixed. It is dynamic. It moves with the economy. Understanding this helps you manage your expectations. You can't lock in 5% forever if the economy shifts. But in the current environment, it's a powerful tool. Let's talk numbers, because this is where the magic happens. Imagine you have $10,000 in an emergency fund. In a traditional big box bank savings account, you might earn 0.01% interest. In 1 year, you earn $1. That's it. $1. It's not enough to buy a coffee. Now, move that same $10,000 into a reputable HYSA with a 5% APY. In 1 year, you earn $500. That's a $499 difference. Over 5 years, with compound interest, that number grows even more. If you never add another dime, your $10,000 becomes roughly $12,762 in 5 years. If you were keeping it in the traditional account, you'd have $10,005. The gap widens every single day. This is the power of yield. It's not about getting rich quick, it's about not losing slowly. Now we need to address the elephant in the room: inflation. You might think, I'm earning 5%, so I'm winning. But if inflation is running at 6%, your purchasing power is still down 1%. This is the real danger. A HYSA preserves your capital, but it doesn't necessarily grow your wealth in real terms if interest rates fall below inflation. However, compared to a checking account, it's a massive win. The goal of a HYSA is not to beat the stock market. It's to beat zero. It's to ensure that when you need that emergency fund for a broken car or a medical bill, the money you pull out still buys what you think it buys. So where are the risks? Is it safe? Yes, if you choose the right institution. In the United States, look for FDIC insurance for banks or NCUA insurance for credit unions. This means your money is insured up to $250,000 per depositor, per institution, in the event the bank fails. This happened recently with Silicon Valley Bank and others, which shook people's confidence. But for the average person at a large, stable bank, your money is incredibly safe. The risk isn't that the bank disappears. The risk is opportunity cost. The risk is that you leave money in a low-yield account while inflation erodes it. That is a guaranteed loss. Another risk is liquidity, or rather, the perception of it. HYSA funds are liquid, meaning you can access them quickly, but they are not instant like cash in your pocket. Transfers can take 1-3 business days. This is actually a feature, not a bug. It creates a cooling-off period. If you're tempted to spend your emergency fund on a new TV, the delay makes it harder to impulse buy. It forces you to pause. Use that friction to your advantage. Let's talk about how to choose an account. Don't just go to your main bank. Your main bank wants your deposits so they can lend them out. They have no incentive to pay you high interest. You need to shop around. Look for online banks. These banks don't have the overhead of physical branches, so they pass those savings on to you. Check the APY. Look at the fine print. Is the rate introductory? Does it drop after 6 months? Make sure you understand the terms. Also, check for hidden fees. A good HYSA should have no monthly maintenance fees and no minimum balance requirements. If it does, walk away. There are plenty of options that don't. Here is a common mistake I see. People put all their money in one HYSA. If you have more than $250,000 in cash, you need to spread it across multiple FDIC-insured institutions. Otherwise, you're uninsured on the amount above that limit. For most of us, this isn't an issue, but it's worth knowing. Also, consider a savings ladder. You don't have to put all your money in one place. Maybe 50% in a HYSA for immediate access and 50% in a short-term CD for a slightly higher rate, locked in for 6 months. This diversifies your interest rate risk. If rates go up, you have cash coming available soon to reattempt. If rates go down, you're locked in at the higher rate. It's a simple strategy that adds stability. Let's recap. A high-yield savings account is a safe, liquid FDIC-insured account that pays higher interest than traditional banks. The interest comes from the bank lending your money to borrowers. The rate fluctuates with the Federal Reserve. It protects you from inflation better than a checking account, but it won't make you rich. It's a defensive move, not an offensive one. It's for your emergency fund, your short-term goals, or money you need within the next 1-2 years. It is not for your retirement. That belongs in the stock market, in bonds, or in other long-term investments. So, what should you do today? Open an account. If you already have one, check its rate. If it's below 3%, you're likely leaving money on the table. Move it. It takes 15 minutes. Set up an automatic transfer from your checking to your HYSA. Make it invisible. Then, stop checking it. Let the compound interest do the work. Your future self will thank you. If you found this helpful, hit that subscribe button. We're here to make personal finance simple, clear, and actionable. Next week, we're talking about the Bogglehead portfolio